Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. Global bond yields decreased sharply last month, with 10-year US Treasury yield and 10-year German bond softening by 34 bps and 20 bps respectively. A bull steepening was clearly observed in domestic yield curve as 10-year benchmark yield decreased by 8 bps during the month, whereas shorter end of the curve witnessed 13 to 19 bps decrease. The 10-year G-Sec traded in a very narrow band of 7.01% to 6.92% and closed at 6.93% in July 2024, vis-a-vis 7.01% in June 2024. At the primary auctions, yields of 91-day T-bill, 182-day T-bill and 364-day T-bill softened by approximately 13 bps, approximately 13 bps and approximately 16 bps respectively during the month. Surplus cash balance with the government and excess RBI dividend was utilized in the budget to decrease T-bill issuance calendar by 1 trillion, resulting in lower yields. The final union budget for FY25 turned out to be more fiscally prudent than expected by many. The government has shown its clear intent to follow the path of fiscal consolidation by pegging the fiscal deficit for FY25 at 4.9%, down from estimate of 5.1% given in the interim budget FY25 and also considerably lower than 5.6% in FY24. The gross market borrowing for FY25 is pegged at rupees 14.01 trillion, marginally lower than the interim budget estimate of rupees 14.13 trillion and considerably lower than rupees 15.4 trillion in FY24 RE. Net G-Sec borrowing for FY25 is pegged at rupees 11.6 trillion, 72% of fiscal deficit, broadly in line with FY24 PA. CPI inflation in June 2024 inched higher to 5.08% from a 3-month low of 4.80% in May 2024. The reading came in much higher than the Bloomberg median poll of 4.80%. Food and beverages inflation rose further to 8.36% in June 2024 from 7.87% in May 2024. Vegetables and pulses and products have maintained their double-digit price growth. However, spices have observed a steep decline from 16.31% in March 2024 to 2.06% in June 2024. In June 2024, the CPI ex-food and beverages stood at 2.26%, marking the 10th consecutive month below 4.0%. Core inflation rose slightly to 3.14% in June 2024 from 3.12% in May 2024. In the coming months, CPI inflation is expected to trend lower owing to favorable base effect. In addition, a good monsoon season this year should augur well for the food prices. During July 2024, US dollar traded with a weakening bias and depreciated by approximately 1.7%. The rising expectation of interest rate cuts in the US, along with Japanese yen appreciation following Bank of Japan's decision to further increase interest rates, have collectively contributed to US dollar indexes slide during the month. Bank of Japan's decision to increase policy rate from 0.01% to 0.25%, along with a detailed plan to reduce the Japanese government bonds purchases, aided the currency to appreciate by 7.1% during July 2024. Though Japanese yen appreciated during the month, it still remains substantially weak relative to Chinese yuan renminbi, Indian rupee and Indonesia rupiah. Indian rupee depreciated by 0.34% in July 2024. Indian rupee traded in the range of rupees 83.45 to 83.73 per USD during the month, and closed at rupees 83.73 per USD. Foreign portfolio investments were net buyers in both equity and debt markets in July 2024, with inflows of rupees 32,365 crore and rupees 22,363 crore respectively. Forex reserves reached the highest level at USD 670.9 billion as on July 19, 2024, from 653.7 billion as on June 21, 2024. The outlook for Indian rupee stays favorable for this year as FPI inflows would likely continue in both debt and equity markets, along with potentially higher FDI inflows and comfortable current account balance. However, it remains to be seen how the RBI would keep Indian rupee competitive in comparison to key currencies like Japanese yen and Chinese yuan renminbi. Liquidity conditions improved during July 2024 on the back of higher spending by the government. Even after the GST outflows, systemic liquidity remained in surplus. Systemic liquidity remained in surplus for the whole month with average daily surplus of rupees 114,971 crore compared to an average daily deficit of rupees 49,963 crore in June 2024. In tandem with surplus liquidity, daily average of weighted average call rate, WACR, was lower at 6.51% compared to the previous month's average of 6.64%. Adjusted for the government cash balances which are held by the RBI, the durable liquidity remained in surplus. Credit growth stood at 14.0% as on July 12, 2024 on a year-on-year basis, down from 19.1% a month back. Fall in credit growth was attributable to negative base effect due to HDFC merger that took place in July 2023. Similarly, bank deposit growth moderated to 11.3% as on July 12, 2024, from 12.6% a month ago. Credit growth continued to outpace deposit growth, which continues to be key concern for the RBI. While economic indicators continue to show a mixed picture with no clear indication of the direction in which the economy is headed, current data points towards robust GDP, slowing labor markets and moderating inflation seems to have tilted the odds towards softening of interest rate stance by the Fed. The intent of the Fed to achieve long-term inflation rate of 2.0% on a durable basis remains a valid hypothesis. However, the incremental data for labor market shows greater weakness of economic environment. Three conditions that make the path for the Fed to start cutting rates much easier are: with the backdrop of strong fiscal spending, keeping interest rates higher for longer increases the burden of the interest expense on U.S. government. Real interest rates are significantly high. Currently, real rate in U.S. is at 3%, that is interest rate at 5.5%. Personal consumption expenditures for June 2024 at 2.5%. The U.S. Fed's dual mandate of maximum employment with price stability alludes the possibility that an unexpected weakening in the labor market can induce Fed easing, while solid job growth may not deter the Fed from pivoting if inflation is trending lower. However, scenarios of what can go wrong over next few months and the associated risks that remain are: yields at the longer end in U.S. may remain elevated as supply-side pressures persist. That is likely strong supply of coupon-bearing instruments due to the elevated fiscal deficit. This factor also gets weightage due to volatility in next few months on account of uncertainty regarding who ultimately wins U.S. elections. Markets would be made to guess the net effect of potential tariffs, domestic first policies, lower taxes, and resultant impact on inflation and fiscal scenarios. Given Japan's recent policy decision, yields of JGB may remain elevated, causing Japanese investors to further withdraw funds invested in UST as spreads compress. It's pertinent to note that Japan is the largest foreign holder of UST as of May 2024. Upside risks to inflation remain given the geopolitical conflicts, although commodities have moved downwards in recent weeks. Reasons for being cautious in India are: while domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. India's GDP for FY24 was at 8.2%, and that in itself doesn't require RBI to look for reducing interest rates. The risk of INR to have a depreciating bias basis PBOC, Public Bank of China, may also allow devaluation of CNY to make its exports competitive compared to the JPY. Refer our fact sheet published in April 2024. Although for now, with flows related to inclusion in the bond indices beginning from June 2024, the INR seems to continue to be an outperformer amongst the emerging market countries. The deposit credit gap in the banking system has sustained for a while, indicating that the shorter end of the curve may see higher supply due to the battle to raise deposits in the financial sector, thereby putting a floor for the overall curve. However, reasons capping the domestic yields are: the outlook revision by S&P may result in continuance of foreign investors' active flow, with USD 11.0 BN inflows into debt so far in 2024. Flows from offshore investors due to inclusion in the global bond indices from June 2024 onwards, which can result in a positive demand-supply equation. A reduction in overall fiscal deficit for the year, as announced in the budget with commitment to reduce it further over next few years. Fairly positive real rates. CPI for FY25 projected by RBI is 4.5% and repo rate is at 6.5%, maintained for a while. Overall, the key monitorables for next few months are an interesting battle amongst various macros. Central banks and countries. We have summarized the same below. 1. Bank of Japan, BOJ, versus Federal Open Market Committee, FOMC. Central bank actions need to monitor the impact of Japanese investors choosing to invest incrementally in Japanese bonds as rates rise instead of US bonds as BOJ raises rates and FOMC cuts. And then what is the resultant impact on US bonds as US fiscal remains elevated over visible future? 2. US dollar index, DXY, versus Japanese yen, JPY, versus Chinese yuan, CNY. Currency moves. Base case is DXY depreciates in medium term, which would be INR positive and positive for bond yields as well. 3. Donald Trump versus Kamala Harris, US elections, fiscal, growth, immigration, tariffs, etc. 4. Iran versus Israel, Russia versus Ukraine, geopolitics, impact on commodities and supply chain and thereby inflation. 5. Foreign institutional investors, FIIs, flows versus relative valuation of INR versus RBI's strategy, open market operations, OMO, sales and forex, FX, domestic dilemma, whether to choose flows and thereby appreciation in bonds and currencies, or to choose conservatism and build up currency buffers and maintain real rates higher. 6. Deposit war in banking system impacting shorter end versus structural macro story for multi-years, resulting in demand for longer end, yield curve impact.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.